702. 702. Finance Feature.
14 minutes to 2 o'clock in our finance feature today. A very, very important conversation I'm so excited that we are having is what happens to your pension or your provident fund when you resign. Now, I stumbled upon a conversation happening around this, but I know people who have left their jobs and then had access to money. Some of them have just, it's all disappeared. Others went and sorted out their lives or cleared their debt. But we said, let's bring somebody in to chat to us about what options are available and what you probably should be doing with that money. So we're joined by a friend of the show, holistic financial advisor, Luca Folpini, where we chat about what happens to your pension or your provident fund when you resign. Welcome to the show.
It's a pleasure as always.
Thank you so much for coming through. And I mean, how often would you say this happens in a person's career where maybe more our generation than the previous generation because they love to stay in companies for 70 million years?
Yeah, so I think it does come down to the individual as well. Like you said, different generations. So it kind of depends how long you've been working for a company as well. Because a lot of companies these days only put people on the fund if they've been there for X number of years. And then the younger generations do seem to like to switch jobs a lot in the beginning of their career. So this is something very relevant for them, I would say.
So what usually happens, and I mean, we're being very careful to say you resign. I'm not sure, and maybe I should ask you first, if a person is fired, does our discussion apply to those people as well?
Yes, it definitely would, especially if you were retrenched or resigned, the same thing. Obviously now, if you were fired for some legal issue, there might be differences where that is an instance where you might have to pay some sort of fine or penalty, and that could also then come from your pension. But the more common thing is either you were unfortunately retrenched or you just resigned from your job, and then you have your different options.
And I think I've heard, and I stand to be corrected here, I'm just recalling from memory, a story or two where a person was trying to get access to their pension and then it was held for child support or something along those lines. But there are those exceptional scenarios where you don't just get access to it like that. So let's assume that the person has resigned or they're being let go. And now what usually happens when HR says, great, sign this document, you're done?
Yeah, so unfortunately, it's not actually as simple as it should be. We have a lot of different laws that have popped up over the last few years in South Africa. If we go back to 2021, where we had what was called T-Day on the 1st of March, legislation kind of tried to make pension and provident funds the same rules. In the past, the provident fund, you could always take the full cash portion, but now they made the rules where it'll work the same as the pension with your 1/3 cash lump sum that you're allowed to take, and the other 2/3 you must purchase an annuity at a later stage. And now obviously we've got the two-pot system in place, which gives you access every year actually now to your pension money or any retirement fund that you have. So from the 1st of September 2024, 1/3 of your contributions go into your savings pot. The other 2/3 go into your retirement pot. But to actually answer your question, the options that you will get given are either if you have cash values available, you are able to take that amount. So if you had accumulated money before the two-pot date, where you could still take a larger lump sum, you are able to do that. That's maybe not the most advisable thing to do, but I'm sure we'll get into that just now. Then you can also transfer your pension either to your own private retirement annuity that you might have with your advisor, or into what is known as a preservation fund, where you are literally just taking the funds from your employment's retirement fund and having it under your or your financial advisor's control. I'm sure you can understand this will make it a lot easier for you to actually manage your money rather than letting it just sit at your previous employer, especially if you left because you felt you weren't feeling valued, or if you were retrenched. I'm sure you wouldn't want your money to just sit there. That is also an option. You can leave it with them, but that never really makes sense to me.
Yeah. Before we even get any further, can you share the difference between a pension fund and a provident fund?
So as of today, there isn't really any difference. And that is what I was talking about with the T-Day in 2021. So if you are someone who has a pension or provident or even your own retirement annuity, if you look at your statement, you'll see a lot of different values. Like I said, it's not as simple as it could be. So the main difference, if you look at the pension and the provident from back in the day, when they made T-days, you had vested and non-vested benefits, and those will be balances on your statement. The vested benefits is the amount of money that you could take the full amount in cash. This would be subject to tax. Your first 550,000 would be tax-free. Any amount above that, they tax it at the retirement tax table. So it works similar to your personal income tax, but it's slightly different. And then your non-vested benefits, which is basically what was always in a pension fund, and now a provident fund works the same as well, is you could only take 1/3 of your investment value as a cash lump sum, also subject to the same tax rules. The other 2/3 you had to then preserve in either a retirement annuity or preservation fund. And then when you end up retiring, those 2/3 you use to purchase a living annuity or a life annuity that will pay you your monthly salary.
So just in terms of, I mean, there's something you said about leaving the money with the company. Technically, the company doesn't have your money. They usually have a group scheme.
Correct.
That has the money. So what are the different companies that have schemes? Alexandra Forbes, what are the other ones?
Yeah, so it'll be all of your financial institutions that you can think of. A very common one is Alex Forbes. Your companies like Liberty, Momentum, Discovery, even some of the banks will have some sort of a corporate scheme that they run as well that different companies can use. And then there'll also be some private ones that a lot of people maybe never would have heard of unless you actually work for a company that uses one of their schemes.
So help us, let's use some round figures that maybe can help us understand. So let's say you're resigning from where you work, you still are paying for your car, and let's assume that said person is renting. So they don't have a mortgage, but they are paying for their car, and maybe their credit score is not in an amazing place, but it's okay. Now when they're changing companies, they say you've got 100,000 Rand that was in your fund. Based on the new rules, how much are they allowed to take, and what would you advise that they do? And if they're moving to another company that already has its own scheme, if the option should be there that they move some of it to wherever their new money or new scheme is going to be where they're working.
So once again, it will come down to each individual as well. And obviously with the two-pot, some of the rules have changed now. So with the two-pot system, just to explain it a little bit as well, 1/3 of whatever you contribute goes to your savings pot, which you can access once a year. You can take the full amount out if you want to. You will, however, get taxed at your marginal tax rate on that withdrawal. And then when you do your tax return at the end of that year, for that month, you were seen as having an additional income. So it might actually push you up into the next tax bracket.
Sure.
And you have to pay double tax, basically. So that's something that a lot of people don't actually take into account. And then also a long-term disadvantage of accessing your savings pot is with the two-pot system now, the savings pot is actually your 1/3 cash lump sum that you would take at retirement. If you've got vested benefits, you can also access that as well. But for the younger generations that are only working now once two-pot has been a thing, if you deplete your savings pot when you retire, there's no more cash lump sum for you. You can only take your 2/3 where you have to purchase an annuity that's going to pay you a monthly amount. And a lot of people I've realized don't actually understand that. But now in terms of accessing the money to pay off debt, or like you said, they want to get a car, something like that, it would come down to the individual. So I think that is why it's important for everyone to actually probably have their own personal financial advisor, someone who does my job, and we would be able to help you. Okay, does this actually make sense? Do you have the time to make up for this money that you are now taking? Because it is going to be for your retirement. This could be the difference from you earning your goal. Let's say it was you need 40,000 Rand a month in retirement. If you take 100,000 Rand out now, that could drop you down to only being able to draw, say, 25,000 in retirement. But if you've got the time on your hands to make up those contributions, then it is a discussion that's worth having. Obviously, no one wants to be in massive amounts of debt, so there is always a discussion for it, but it will be down to the individual.
And I mean, of course, a person should not just rely on what their HR says and the company scheme. They can go and get advice elsewhere on what to do with their money.
So yeah, when it actually comes to now you've left the company, if you took a cash portion, that's your choice. The other amounts of money that's there, like I said, you have to do something with it. You can choose to leave it there, but if we are going to be moving it. A lot of the times you can move it to your new employment if they've got a pension or provident scheme in place. And what maybe makes the most sense for each person is if you have your own private retirement annuity with an advisor, you can either put it into your retirement annuity or into a pension preserver. The difference between the two is the preserver will keep whatever rules the funds came from. So if you were in a pension fund where that you had some vested, non-vested benefits, all of that, if you put it in the preserver, you can still at some point access that in the future. But if you go put it into your retirement annuity, those rules are not going to be the same as what it was in your original fund. So that also comes down to the individual. If you think you might need this at some point, I would then say put it in a preserver. At the end of the day, when you retire, there's no difference to what happens with the money. It's treated as the same. So it just comes down to the individual once again.
And of course, make sure you consult before you ink whatever document you're going to ink, because it might seem like money today, but have massive tax implications when you do so. Luca, thank you so much for chatting us today on our finance feature.